Good afternoon, everyone. My name is Ivan, and I'm the Chief Operating Officer at Buckworths. Thank you so very much for joining us at our webinar on rising investment for food and drink startups. We are going to cover our speaker today is our Managing Director, Michael Buckworth. And Michael is going to cover everything that you should be aware as a food and drink business when you go through your first investment round, how to structure it, how to attract investors, top tips, and any mistakes that should keep in mind and avoid. During the webinar, if you have any questions, please share them in the chat box. We are going to read them at the end of the presentation and answer all of them. So thank you very much for attending. Enjoy the session, Michael.
Hi guys, welcome to this chat. Thanks, Ivan. So as Ivan said, the idea of today's session is to run through all the things that you need to think about as you sort of raise investment. So very much looking at it from the perspective of you guys as food and drink startups. Before we start, just a bit about us. So I used to work on the dark side of law, doing sort of $500 million plus M&A for two big New York law firms. Back in 2011, I set up Buckworths, and we work and have always worked exclusively with startups. So for us, startups is a little bit of a loose term. It's everything from founders pre-incorporation all the way through to exit. Most of our clients are sold at the top end by about valuations of sort of 100, 150 million. Obviously, the vast majority of our clients are smaller than that. And you know, clients exit and you know and sell at sort of lower valuations, but that's sort of very much sort of the space that we play in. In terms of sector, as a firm, we're really known for two things. We're known for tech on the one hand, and then food and drink, by which I sort of loosely include sort of hospitality restaurants on the other. So we've sort of got a strong presence in both. Obviously, today is very much about the food and beverage section. The stuff we're going to cover is just there. So we're going to have a brief think about other sources of funding, you know, above and beyond investment, just because in this sector, you know, those other sources of funding are actually really important. I would say probably more important than a lot of other sectors. So we'll touch on that. We'll then have a little bit of a think about investment. So particularly the tax reliefs available to investors in F&B startups. Always useful in these presentations for me to flag investors that are active in the market. So we'll have a look at some of those, and then we'll run through some practical stuff. So the kind of questions that you should expect investors will ask you, how to deal with them, how to engage with investors, top mistakes that founders make, and then a final just practical point on the maths of cap tables, simply because almost all founders I speak to at the moment are getting the maths wrong, and it's a very, very expensive mistake potentially. So, thinking about other sources of funding, there's a couple of areas that I wanted to flag on. The first of which is grant funding. So there's lots of sources of grant funding, and particularly in the F&B space, there are all sorts of sort of smaller grant bodies that can help out. So, you know, as an example, we did bits of work with something called Growing Kent and Medway, and they are basically an organisation that supports food and F&B startups who are in the Kent area. And they spend a lot of their time networking their startups with grant funding bodies, both in the local area and more broadly, sort of nationally. So don't forget grant funding. The big stuff, if you're doing something really innovative that's sort of creating a step change in the way that things have worked, or the way that things work, the big money is Innovate UK. What I would say about Innovate UK is the number of grants applicable to this particular sector are relatively small. However, worth having a look at them, because you know, if you can get an Innovate UK grant for sort of for R&D stuff, then it's a very, very good source of non-dilutive funding. Grant funding, by the way, normally is free cash. But beyond Innovate UK, keep an eye on sort of other grant funding bodies, whether it's the local authority, whether it's universities, whether it's bodies often interacting with universities who are looking to sort of help F&B businesses grow. So have a look at grant funding. It's super useful. As a general rule, what I would say in terms of sort of applying for grant funding, most grant applications take a very, very long time and they take up a lot of focus. So when looking at a project or a grant, only apply for stuff that is genuinely, your business fits really well. I see a lot of founders, frankly, waste a lot of time applying for grants when it's kind of could be a bit relevant to what they're doing, but it's not their actual core. There are 100 million, exaggeration, but there are going to be 1,000 other applicants who, for whom every single grant will be absolutely smack bang in the middle of what they're doing. So, within reason, try not to squeeze your business into a grant that it's not really sort of relevant. In terms of suitable resources, the Food and Drink Federation has got a really good sort of list of grants. They post a lot of stuff on their social media about sort of grants that are current and that kind of stuff. So have a look at that. Second thing I wanted to talk about was self-funding and debt. So the sort of theory here, always a little bit theoretical, but the theory here is often it is better to fund a business yourself, maybe the whole business forever, or maybe just the earlier stages, rather than take equity investment. And the rationale goes, if you borrow money, let's say you borrow 20 grand, yes, you will have to repay that 20 grand and you're going to have to pay interest on it. But hopefully, if your business is successful, that £20,000 will generate a business that grows and scales and is really valuable. And crucially, when you borrow money, you're not giving away shares in your company. So you've borrowed 20 grand, you still own 100% of your company. If you compare that with taking investment, you take 20 grand investment off an investor, they are going to have an frankly unrealistic expectation of what equity they should get for their 20 grand. And very simplistically, you may end up giving away 5% of your company for 20 grand. If your business is successful, I guarantee that 5% will be worth many multiples of 20 grand. So you took 20 to give somebody 5% of the company. When you come to sell, that 5% is going to be worth that 200, 500, £1 million. It's that money has come out of your pocket because your percentage holding of the company at the point of exit is smaller. So the logic goes, within reason, if you self-fund, you avoid giving away equity, you avoid dilution, and that's better in the long run. As far as investors are concerned and thinking about the way that this looks to future investors, I think there is some comfort that investors take when founders have self-funded to a certain point. It shows the founders believe in their business. They're prepared to put some skin in the game to get their business up and running. It shows conviction. And I think that's a very nice sort of position and thing for investors to see. So strategically, a bit of self-funding can be a good idea. However, and I think there's a massive caveat here, what you do not want to do is put all of your money into your startup. Why? 65% of startups of every sector fail. In the F&B space, it is significantly higher. I think the latest percentage is about 75%. So statistically, you are probably going to fail. Not a nice way of thinking about it, but go with me for a sec. If you have remortgaged your house, you have got to the point where you have absolutely no way of living. If your business fails, that is a horrible position to be in and not a position that, frankly, you should ever put yourself in. So I think there's always a balance here. Equity investment reduces your risk. You shove that risk onto someone else, and that can be a very worthwhile thing to do. So you have to make a decision on this, but those are sort of the thinking points. If you do decide to self-fund, then there's a couple of sources of funding. So the obvious one is startup loans. These are effectively government funded, government-backed loans. They are personal loans to you as an individual. So it's a loan of 10 or 15 grand. You use it to grow your business, but crucially, it's a loan to you, not your business. So if the business fails, you will have to repay that loan. It's a personal liability. You can also get entrepreneurship loans through the British Business Bank, often through the high street banks, sort of sponsored by them. They tend to be at better rates than borrowing from Tesco loans or something like that. And you can potentially get traditional term loans, overdrafts, all the stuff that you would potentially expect to see from high street banks. What I would say to you is entrepreneurship loans, term loans, overdrafts, all that kind of stuff. For a new business, almost certainly the banks will want a personal guarantee from you. And what that means is if the company fails and it cannot afford to repay the loan, you have to repay it. It flips to you and becomes a personal liability. For founders of startups, I would say think very, very carefully before giving personal guarantees. For all the reasons I just talked about, there's a reasonable chance your business will fail. Or to put it differently, lots and lots and lots of founders come to me. They have taken a loan, they've given a personal guarantee, the company is failing, and the bank is talking about bankruptcy. There is very little that we can do. There is some stuff, but bluntly, that's a liability that you have. If you can't afford to repay it, your house is at risk, your car is at risk, you could be made bankrupt. So think very carefully about this stuff. Final thing before getting on to sort of true equity investment, I wanted to talk about crowdfunding. So with crowdfunding, there is equity crowdfunding and debt crowdfunding. So the equity crowdfunding is essentially akin to investment, issuing new shares to investors in exchange for them making an investment in your company. And then debt is obviously borrowing money from lenders on the basis that you'll repay it in the future. Equity crowdfunding in the current market is by a long way the most common approach. And the two biggest platforms for this are Crowdcube and Republic. And Republic used to be called Seedrs. So what they are is they are FCA authorized platforms that theoretically bring together a whole bunch of investors, mostly what we call angel investors, so high net worth individuals who've got some money to invest. So the theory is you post a slick campaign video on their platform, you upload a bunch of information about your business, tell people what it is that you're doing. And then the platform brings through some very cool SEO and cool marketing, all of these investors to your campaign. They pledge at the end of the campaign period, which is normally about 30 days, you have hit your target of 500,000. And then the platform closes out the round for you and you get your investment. That's the theory. The reality is it isn't quite as straightforward as that. So the first thing that is really important to understand, when you use these crowdfunding platforms, you need to bring between 30 and 50% of the amount that you're trying to raise to the platform. So you have to bring investors for that amount. The reason for that is very simple. Investors are a little bit like sheep. No investor wants to be the first person to pledge money to a campaign in a startup because it feels very risky, right? You know, they're the first person who puts in 10 grand. Feels like a pretty risky thing to do and a bit scary. On the other hand, if they see that everyone else in the community is pledging money to the campaign, then they get FOMO. They think they're missing out on a really good opportunity. And so then they will pledge. So what you do with those investors that you bring to the platform is you trickle in their money. So, you know, you get them to, through the life of the campaign, make a pledge, a further pledge, a further pledge, a further pledge. And that shows traction. It shows that the target is being reached. And that triggers your investors who you don't know to get FOMO and to pledge as well. So that's kind of that rationale. What that means in practice normally is that the best time to do a crowdfunding campaign is not as your first round and not early stage. It's actually when you've already raised 1 or 2 rounds, you've got investors in your cap table, and then you can tap them up to provide that 30 to 50% of the crowdfunding money. So often crowdfunding is better for a later round. Now, there are some, by the way, there are, as always on this kind of stuff, some great examples of people who've done their initial round on crowdfunding, raised millions of pounds, and it's been an absolute doddle for them, but they are few and far between. Final point just on this timing point for crowdfunding. In my view, in my experience, the best time to do a crowdfunding campaign is actually when you have a product in the market, particularly if it's B2C. And the reason for that is what these platforms have is huge networks, and they have very good SEO and marketing capabilities. So we all focus on raising investment through the platforms, but actually they're really good for marketing and for clients and customer acquisition. So if you've got a product, it's in stores, it's in supermarkets, a crowdfunding campaign is actually a really good way of making interested, engaged people aware of it and helping your revenue numbers. But again, that probably means you're not doing crowdfunding in your first couple of rounds. You're probably doing it, a little bit later when you've got that sort of product in the market and things that people can buy. So on to equity investment then. So when we talk about raising an investment round, mechanically what happens is the company issues new shares to third-party investors, and those investors pay for those shares. So the really important thing to remember is you are not transferring any of your existing shares. So let's say you've got your company, you are the sole shareholder, you own or you hold 10,000 shares. When we take investment from investors, we'll issue further shares, and we may end up in a position where there are now 11,000 shares in issue. So you still have your 10,000 shares, but there are now 11,000 in issue, meaning you no longer have 100% of the share capital. You have 91, 92% of the share capital because that denominator has gone up. And when we talk about dilution, that's what we're talking about. We're talking about your percentage holding reducing. In terms of types of investor, so for earlier stage F&B businesses, you're very likely to be looking at angel investors or early stage funds. So angel investors are relatively high net worth individuals. They tend to be looking for two things: a business that will grow and scale, and hopefully they'll be able to sell their shares in the future at a multiple of what they bought them at. And they're looking for tax relief. And we'll talk about tax relief in a sec. But angels are essentially scalable business and tax relief. Early stage funds, which is the other sort of key source of investment for F&B, early stage F&B businesses. Early stage funds covers a multitude of different types of people. So most early stage funds are actually fronts for an angel network. So think SFC Capital, Jensen, those sorts of people. What they are is they are an organization who effectively source startups that their investors can invest in. They do due diligence on them. They negotiate the investment documentation. And they provide what's called a nominee company. So this is a non-trading company whose sole purpose is to hold the shares for their investors. So on Companies House and on your cap table, you have one shareholder normally, which will be, SFC Nominees Limited. That shareholder, that nominee company, holds the legal title, so the actual name, the person who's named on the shares, they hold the legal title, but the beneficial interest, so the right to profits, the right to sell proceeds, is held by underlying angel investors. So the way to think about these sorts of funds is it's a nominee at the front and then a whole bunch of angel investors behind. Now, you guys as founders probably don't really care about who those angel investors are. What you care about is you've got a shareholder called SFC or Jensen or Ascension or whoever it might be. But useful to know that that's sort of what they're doing in the background. So those are the sort of early stage sort of SEIS and EIS funds, so tax relief funds. You also have proper VCs who will invest in that sort of early stage. And VCs are slightly more formal structures. The shares are often held by a nominee, but there's a sort of often regulated fund that sits behind it. And the money in that fund comes from very high net worth investors, some institutional money, so potentially things like pension funds, company money perhaps, and a lot of government money. So most VCs are backed by the government in some form or another. And the people who run the fund managers, they make the investment decisions and they invest that money as a fund. I think the way to think about the difference between angel investors and early stage funds is around terms and valuation. So often what you find is valuations are a little bit higher when you raise with angels. And the reason is angels tend to be more relaxed. They're getting their tax relief. They are investing in you as an individual, and to a degree, they tend to be a little bit more comfortable with taking risk. So valuation's a little bit higher, and also the terms that you sign up to, so the provisions, the restrictions on what you can do, they tend to be lesser with angel investors. When you work with early stage funds, they have fiduciary obligations to their investors, so they tend to push you down on valuation. They tend to have a lot more restrictions about what you can do. So they might want a board seat, so they might want to appoint a director. They might want a bunch of consent rights, so things you can't do without their consent. So with early stage funds, there are more strings attached to the investment. In terms of timing, early stage funds tend to be much quicker than angels. So with early stage funds, you're negotiating with 1, 2, possibly 3 funds. You're going to have one of them as a lead investor. You negotiate with them. It's sort of rolled out to other people. You can get these deals done in 2, 3, 4 weeks, and it's nice and straightforward. Angels tend to be more complicated. So you may have a relatively large number of angel investors, 5, 10, maybe more. You might negotiate with one of them, but then the others will have slightly different views. Some angels are more sophisticated than others, so it can be a slightly messier, a slightly slower process. There's no right or wrong in terms of which you choose, by the way. And sometimes you don't have an option. Like you may find that angels won't talk to you, early stage funds will, and vice versa. So that, if you have that choice, there are sort of pros and cons of each approach. As I said, angels are looking for tax relief. So there are 2 tax relief schemes that are applicable to UK angel investors. And by UK, what I actually mean is angels who have UK tax liabilities. So 90% of the time, these are angel investors living in the UK, but it is actually possible to have an investor, say, living in Sweden, who has, for whatever reason, got a UK tax liability. They can use these schemes. The baby scheme is called SEIS, so the Seed Enterprise Investment Scheme. And that applies to the first £250,000 that a company raises from angel investors claiming tax relief. The biggest scheme is called EIS, the Enterprise Investment Scheme, and that applies to the next 10 to 12 million pounds that you raise. So SEIS 250, EIS 10 to 12 million. The way these schemes work is they incentivize investors to make what the government views as high-risk investments in startups. And the way it incentivizes them to do that is it gives them a bunch of tax reliefs. So at a very high level, you get an upfront income tax relief, which is 50% under SEIS, the baby scheme, 30% under EIS. And what that does is it gives investors in a startup that qualifies for the scheme up to 50% of what they invest back as a credit from HMRC against income tax liabilities that they have paid or will have to pay in the tax year they make the investment or the previous tax year. So I invest 100,000 in your startup under SEIS, I get 50,000 back. There are then what we call capital gains tax reliefs. So these allow an investor who's disposed of an asset and on which there's a capital gain arisen. So for example, I might have disposed of a rental property. I've got a capital gain of £100,000 on which I will have to pay capital gains tax. If I invest that under SEIS, my capital gains tax liability is reduced by half. If I invest it under EIS, my capital gains tax liability is delayed until I sell the EIS shares. So that's sort of the upfront capital gains tax relief, different under the 2 schemes, as I just explained. There is a tax-free exit. So when investors come to sell their shares under SEIS and EIS, as long as nothing's gone wrong, they pay no tax whatsoever on any gain that they make. And that is currently, frankly, shockingly, completely uncapped. So tax-free exit. And then there are some additional ones. There's a loss relief. So if the business does go bust or shares are sold at a loss, then investors get a portion of that loss back from HMRC. and there is an inheritance tax relief. So if in certain circumstances an investor passes away, those shares pass, or the shares that they held pass tax-free to their beneficiaries under the rules of the scheme. So lots and lots and lots of tax relief available for investors using these schemes. The nice thing is the schemes apply to most types of business. So in F&B, almost certainly what you are doing will qualify for these schemes. There are things that can be a problem. So the classic that is a problem in this space would be if you're effectively exploiting somebody else's intellectual property, and that can cause you an issue if, for example, your manufacturer owns your formulation. So it's one of the things when we review manufacturing agreements that we keep a very careful eye on. You need to make sure that all intellectual property or all material intellectual property, of which your formulation is one, are owned by you. And sometimes that is not the approach that manufacturers take. But very simplistically, if you're in an F&B space, you should be qualifying for these schemes and they should be available for you. What I would say, if you want to raise investment from angels or early stage funds, you must have pre-qualified for these schemes. And the way that you pre-qualify is you get something called an advance assurance. An advance assurance is essentially a confirmation from HMRC that the business that you are proposing to carry on will qualify for the schemes. On the screen, I've put some of the detail of the way these schemes work. So for SEIS, it's the first £250,000 that you raise from angel investors. You've got 3 years from commencement of trade to take the investment. Commencement of trade is normally first revenue. So it's not incorporation, first revenue, you have 3 years to raise your SEIS. When you raise the SEIS, you can't have gross assets of more than £350,000. So the common mistake that people make here is they let their accountants capitalize time spent on building stuff or creating stuff, and you end up with a big asset value that will void your SEIS. So don't let your accountants do that. And the maximum amount that any individual investor can invest in SEIS in any tax year is 200,000. EIS technically a very different scheme actually, but conceptually pretty much the same. So you have 7 years from commencement of trade to raise EIS money, unless you're a very heavy R&D company, in which case you've got 10 years. And there are some sort of complex rules about raising investment beyond that 7-year period, which are not really relevant to this discussion. In terms of where to go for investment, it's very tricky in a presentation like this to sort of give you a definitive list. And the reason is because different funds have different sort of priorities at different times. Those people on the screen are early stage funds who are currently pretty active in the F&B space. And bluntly, some of the people I most like to work with. So SFC Capital, they used to be Startup Funding Club pre-COVID. They flipped into an early stage fund. They do, I think now, more early stage investment than any other fund in the UK. Very good bunch of people, very smart. They generally seem to be making pretty good investment decisions. A lot of their portfolio companies do very well. And just in terms of the way they behave, they're a very nice investor. So they'll introduce you to other funds. If you need consent from them, they're generally pretty chilled. So I always sort of recommend SFC. BGF, which is Bethnal. Do I mean BGF? No, I don't. So sorry. BGF is a fund that they have a fund specifically for food and drink businesses. Again, pretty active. We have a number of clients who've taken money from them, and they come very highly recommended. Bethnal Green Ventures, again, very good, very, very active. If you go on their platform, they've got some really interesting portfolio companies that are in the space. And we've had lots of clients who've raised money with them. Invitec, quite a big VC. They again, very much active in the space, great things. Balderson the same. Unilever Ventures is really interesting. So Unilever, obviously the big company that owns lots of products, they have a venture company that invests in sort of product businesses. if you that they're very focused on consumer, so it tends to be consumer goods. A lot of what they do is not F&B, so it's health and beauty, that kind of thing. But if you're in that crossover, you've got a food and drink product that perhaps has a crossover with health or something like that. Unilever Ventures are a good person to talk to. Very, very well connected, and every single client who's actually raised money with them has been sold north of 100 million, and there's about 6 or 7 of them. So maybe they're very good at choosing the right people up front. Maybe they add a load of value, but certainly every single person who's taken money from them within who we've acted for has sold for a very decent amount of money. So worth having a look at them. On the bottom of the slide, there's a link that I found a couple of weeks ago that is a list of F&B and angel investors in the UK. Now, a number of the people on that list I don't know, I'm not aware of, but a number of them I do know, and they've invested in some of our clients. So as far as angel lists go, and by the way, they tend to not be terribly accurate, but as far as angel lists go, this list seemed to have at least sort of 10, 15 people who probably should be on that list and who I know invest quite regularly in the space. So, if you're looking at angels, that may be a good place to start. Message people on LinkedIn, do all that stuff. I wanted to talk about some of the questions that we see people in this space get asked and sometimes trip up on. And so just sort of running through them. The first one, on whom are you reliant, is a really important question, and something that, often I think founders haven't necessarily thought through. So what investors are getting at here is, let's give an example. So you've got your product in, it's a food product. You've got it in a couple of small supermarkets. You are just about to, you've got an LOI with Sainsbury's. You're just about to get into Sainsbury's, and you're raising investment to fund that scale up. You need to produce a bunch of products that can go into Sainsbury's stores. You need to have the comfort that you can do that in a reasonable period of time, etc., etc., etc. So that's where you are, and you're raising investment for that scale up. Your investor says, okay, we love the business, we love the product, but what are the risks? What can go wrong? On who are you reliant? And the answer is often, well, we're reliant on our manufacturer. If they don't deliver on time, we are going to suffer big financial penalties with Sainsbury's because we have fairly strict timelines, and if we don't meet them, we get penalized. Maybe you're reliant on sort of delivery providers. You have a degree of tech reliance. And the follow-up question that tends to come is, well, what can you do to reduce the risk of something going wrong? And so with manufacturers, what that often looks like is 2 things. It's number one, having an agreement in place that has very, very clear deliverables, timelines, quality standards, so that if they breach them, you have direct recourse and can ideally recover the damages that you pay to Sainsbury's for late delivery. In parallel with that, of course, you want to have as flexible terms with the supermarket as you possibly can. But focusing on that manufacturer agreement is really important. What I would observe is manufacturing agreements tend to be one of the weakest areas for a lot of F&B startups. They've kind of done it themselves, or they've been presented with a manufacturer's agreement that they have felt they can't negotiate, and it's full of exposure for them. So that is something that's worth thinking about. Smart investors will push you on that. The other thing with manufacturers is it's worth having a plan B. Now, I realize it's expensive. It takes up a lot of time. It's very difficult to keep manufacturers on sort of interested if you're not signing contracts with them. But having a plan B, we find very, very frequently that startups will work with a manufacturer, and what will happen is, because their order quantities are not big enough, as soon as that manufacturer is busy with a bigger order, they will just delay and drop, and you'll find that all the stuff they have promised just will not happen in terms of delivery timelines. If you have a contract with a big supermarket or a big distributor, and you're not hitting their delivery timelines, there will be repercussions for that. And so you need to have a plan B if your manufacturer stops delivering in the terms that they should. Next question, what steps are needed to get to launch? Fairly obvious, but have a sort of key idea of what that might be. Are you a consumer focused brand or a business focused brand? You know, every so often investors will give me feedback about pitches that clients have done, and they'll say, you know, they came in, they told us that they were consumer focused, but we just don't get it. Like it doesn't make sense as a business concept. They need to be B2B. And the weird thing was that some of their slides were clearly B2B. And it's that kind of, well, if they don't know which they are, then we're not going to invest in them. So having an understanding of where your core focus is, I think is really important. Inevitably, how are you going to scale up? How are you going to get in supermarkets? Are you talking to the right people? You know, if you don't have contacts with the right buyers, are you speaking with people who can introduce you to them? By the way, are you speaking with the right buyers is often the basic. So that is really important. Who are your competitors? Something that in this space, I think people can be really naive about. I was speaking to a client the other day who essentially it's a health drink. It's got some cool stuff in it. It's got lots of electrolytes. It's sort of aimed at people with a specific illness. He believes he has no competitors. He does. In essence, most health drinks are his competitor. The fact that he's tailoring this just at a bunch of people with a specific illness doesn't mean he doesn't have competitors. It just means that he's playing a marketing game to sort of make himself appear the most suitable person for this particular type of individual. So understanding what your competitors are and how you can compete with them is super important. How you spend investment monies, a pretty obvious one. What market product testing have you done? What are the barriers of entry for competitors? And crucially, how did you arrive at the assumptions in your business plan? Something that, again, lots of founders can't answer. And I always say this in presentations around financials. So the single biggest mistake I think founders can possibly make is to not do their financials themselves, at least the first draft. So, you know, you will be presenting to an investor or giving to an investor at least cash flow forecasts and profit and loss forecasts. The temptation is to say, I'm not a numbers man. I'm not an expert at this. I am going to go get an accountant to do this for me. It's a huge mistake. The accountant will do it. They will explain it to you, and I guarantee you will never ever fully understand those numbers. If you do those spreadsheets yourself, you sit down and you literally say, okay, I'm selling a drink. How much is each plastic bottle? How much are the ingredients? How much is my transport cost? How much is duty am I going to pay if I'm importing stuff? You do all of that research and that maths yourself. You put together those forecasts. I guarantee at the end of it, you understand your business. You can then take it to an accountant and they can say, oh, my experience, that number's too low, this number's too high, it's actually going to take you this long to do this. And they can change those numbers for you and give you that sort of expert opinion. But the crucial thing is you understand the basics of your business. If you don't do that heavy lifting, you'll never get it. And I think that's the really important point. You need to be able to understand your assumptions and explain them to people. In terms of engaging with investors, look, there's no right or wrong way of doing this. What I always say is you want to try to build your own network as best as you can. That doesn't mean that, you know, you can't raise investment unless you've got 100 VCs sat in your network. That's not actually what I mean. What I mean is that you should go out there and tell people about what you're doing. So I joke, talk to people on the tube, be the crazy person who starts chatting to the person next to them. Tell people about your business, keep in contact with people, add them to a mailing list or LinkedIn or whatever it might be. What you'll find is that people who are interested in what you're doing are easy enough to keep engaged with. When you come to raise investment and you reach out to that big network of people who are interested, you would be amazed how many of those people know investors, have investors who've invested in their startup and who they think will be good for you, perhaps even who are investors. The best example I have of this, and something that you know, still amuses me, a client of mine, he had now a very famous food and beverage business that he sold about 2 years ago for hundreds of millions of pounds. He 5, 6 years ago was setting up his business, and he was on a flight to New York, sat in, I don't know, premium economy or something like that. And at the time he was single, and he decided, as you do, to chat at the lady sitting next to him. And so he was kind of playing the big I am. I've got this cool food and beverage startup. It's going really well, you know, blah blah blah. It transpired that she was a partner in a New York VC who happened to have a specific fund who were doing F&B investments. She liked what she heard. Didn't go on to date him, I should say, but she liked what she heard about the business. And that VC invested across 3 rounds, a total of £2.5 million. And that was because he was on a flight chatting up the lady next to him. So talking to people can be a really useful way of dealing with this kind of stuff and getting investments on board. It's really important to get your public messaging right. The number of times that founders come to me, often when we're doing that advanced assurance for SEIS and EIS, and they give me a pitch deck and they give me some financials. And I look through the financials and I go, great, 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 lovely, lovely. I look to the pitch deck and I see that the slide in the pitch deck that summarizes the financials has got absolutely no bearing to the financials that they've given me. So that's immediately problem number one. Your spreadsheets don't match your pitch deck. I then go onto their website, and their website talks about a different product or a different rationale to what their pitch deck says. And I go on their social media and it's doing all sorts of weird and wonderful stuff. The reason is easy to understand. So their business has changed. They've developed the proposition. They've pivoted perhaps a little bit over time. And the different assets they have haven't been updated. In all likelihood, they focused up primarily on their pitch deck because that's the bit that we all want to look pretty. The financials are a year out of date. The website they haven't got around to updating. Their social media is being done by an intern somewhere who is much more interested in partying than their product. And it just doesn't quite fit together. We all get it, but it's really not a good look for investors. It makes it look like you're winging it. It doesn't give that concerted messaging that investors want to see. So try to make sure when you raise investment, everything is broadly aligned. Engaging with customers is a really good way of raising investment. It's a little bit later stage, perhaps, once you've sort of raised a couple of rounds, you've got your products in the market. But if you've been smart and you've engaged with your investors, you've got them signed up to mailing lists, you've perhaps been sending them offers on discount products and all this kind of stuff. What you can then do if you want to raise a crowdfunding round is you can actually message your investors, drag them into your crowdfunding round, and use that as a way of raising investment. So engaging with customers is a really valuable thing to do, both for general business terms, but also for raising investment. And then the final thing, as I touched on a moment ago, when dealing with investors, you do need to understand your financials. I can't stress it enough. Understanding what numbers make up your forecast is absolutely vital. Understanding how you came to the valuation you're raising at, and understanding and being able to explain and justify how you're going to spend the money, they are the 3 basics of an investor discussion. And it's super important that you're sort of sussed on that one. Top 3 mistakes that I see people make. The first one is hiding their business idea, keeping it secret, not talking about it. And it normally comes about because they're scared somebody will nick the idea. What I would say to you is, take me as an example. I've worked with startups for 15 years now. I have a massive network of all sorts of consultants, experts, founders. I know manufacturers. I know product designers. I know people who can do logos and websites and all this kind of stuff. Obviously, I wouldn't, and I'm not able to because I'm a solicitor. But you come to me with your business idea, indeed your business plan, your pitch deck, or your financials. I would be completely unable to take your business and do it myself. Why? Because your business idea has come from your own experience. It's come from your expertise, what you've done in your life. I don't have the experience that you have. And for me to come along and set up a business selling a food product or a drink product, I don't have the inclination to do it all the time. But B, I can't do it. The way to think about this, I would say, is investors have a simple business proposition. They give you cash, and you slug your guts out for 5 years making them rich. They're not interested in doing this work themselves. Startup founders normally have their own business idea, and let's be honest, their business idea is better than everybody else's, because if it wasn't, they wouldn't be wasting all their time and money focusing on it. They're not really interested in nicking your business idea, no matter how good it is. And crucially, they can't. Particularly in the early stages, when you sort of say to a co-founder who comes and meets with you, I'm doing a CBD drink that is going to help people with diabetes. Great. That tells me absolutely nothing that would enable me to replicate your business idea. So I think talk to people about your business. That's the best way of building up your network. The second thing is investments, particularly early stage investments, should be super straightforward. There are two models that you might use. The first one is a priced round. So I'm an investor. I put money into your startup. The shares are issued straight away at a price per share that we have pre-agreed. That's structure number one. Structure number two, we use something called an ASA, or sometimes a SAFE, seed fast, all the same stuff. And what happens there is I put the money in today, but the shares are issued in the future, normally 6 months later, at a pre-agreed price, or potentially at a discount to the next investment round price. Those are the only two structures that you should be using for investment rounds. If people come to you and they say, well, what we're going to do is we're going to do tranched investment. We're going to put, the first tranche in today, the next tranche in a year's time, the next tranche after that. Don't do that. That's a really bad idea for lots of reasons. If people come along to you and say, we're going to put money in from a different company, we want you to lend that money to this company here, and then it will convert into equity here, and this will happen and that will happen. That's probably fraud or money laundering. And if people are doing stuff that simplistically doesn't make sense to you, talk to a lawyer or talk to an accountant, but there's probably something wrong. So don't do stuff that is complicated, because it's generally a red flag. And then the final sort of the final of the three mistakes is raising too much or too little. So easy for me to say as a lawyer, sometimes more difficult to get it right yourselves. If you raise too much, what you've done is you've given away too much equity. So the idea is you raise enough money for you to run your business for 12 months. Once you have that money, you spend it, your valuation should go up, because you've launched your business, you're generating traction, you're doing all that positive stuff. If you raise too much, you raise more than you need, then you've given away shares at today's lower valuation, when what you could have done is raise that excess in a year's time at what should be a much higher valuation. And obviously, the higher the valuation, the less equity you give away. So raising too much means more dilution than you need. The flip is, if you don't raise enough, you're going to run out of cash. Maybe because you didn't raise enough, you haven't been able to get the traction you needed to hit your next target valuation. So you end up either raising money in a distressed position because you desperately need cash, or you end up raising money at a lower valuation than you should have done because your business hasn't been able to grow and scale. Very difficult sometimes to get this right, but that's kind of the thinking. Final thing then, before we go on to questions, is just this maths point. So the point here is around percentages and what percentage the investors will get. Let me just give an example. I'm investing £100,000 at a valuation of £1 million. What percentage am I going to receive? If any of you are thinking 10%, you're wrong. I walked you into it, but you're wrong. The answer is it's 9 point something, I think. So when we talk about a valuation, so I'm raising my investment round at a valuation of, I don't know, 900,000. That's called a pre-money valuation. So it's the value of the company today before pre-investment goes in. The post-money valuation is the valuation of the company after an investment's gone in. So pre-money plus the investment itself. So if I invest 100,000 at a pre-money valuation of 900,000, the post-money is 1 million. To work out the percentage the investor will receive, you take the amount invested divided by post-money. So 100,000 divided by that post-money of 1 million, that's 10%. In my earlier example, 100,000 divided by a pre-money of 1 million, so post-money of 1.1 million, that would have been, I don't know, 9 point something percent. Often getting this wrong is quite expensive because what we see founders do is they say, if you invest 100,000, you'll get 10%. They don't reference evaluation, and the investor will say, well, I'm getting 10%. I don't care the fact you got it wrong. I'm getting 10%. I would actually say try not to talk about percentages at all. And the reason is, you can probably see from that formula, if the amount that you raise goes up, the percentage of the investor goes down. So £100,000 at a pre-money of £900,000 is 10%. But if the company raises £500,000 at a valuation of £900,000, well, the post money is 1.4 million, meaning that my 100,000 is not going to get me 10%, it's going to get me a much smaller amount. So try not to talk about percentages, try to talk about valuations. Wonderful. If you've got any questions, we're going to run through them now. You can scan the QR code on the screen if you would like to book a call with me. Or we also have at the same link a sort of a calculator you can use to see if you are eligible for SEIS and EIS. So if you've got any questions, pop them in the chat. Ivan, have we got any questions so far?
Thank you so much for the insightful presentation, Mike. We've got a couple of questions. I'm going just to select a few because I'm cautious of the time. And the first question is from Tanya. My manufacturer has created the formula for my product and owns the IP. Is that a problem?
So we touched on that earlier, didn't we? So it can be a problem. So there are a bunch of different ways for an F&B startup to qualify for SEIS and EIS. One of those ways is to say to HMRC that you're exploiting intellectual property that you have created as a business. And the benefit of using that route is it potentially gives you the ability to extend the SEIS period from 7 years to 10 years. If you are using that route, then you need to the company needs to own substantially all of the IP that it's using, and that would include the formula. So you don't want a situation when the manufacturer retains the IP in the formulation. What you sometimes see is manufacturers saying, we'll transfer that intellectual property in the formulation once you hit a certain minimum unit number. So once you've ordered, I don't know, 100,000 units, we'll transfer that IP across. You also see sometimes they're saying you can buy the IP for an extra fee, 10 grand, 20 grand, whatever it might be. Neither of those things are particularly good and frankly not really necessary. I would say to you that there's limited, if any, value in the formulation because formulations tend to be manufacturer specific. So really, you just don't want that provision in there. You should be owning the IP from the get-go.
Perfect. Thank you, Mike. The next question that I'm going to take is from Vic. Are there VCs for people from diverse backgrounds, for example, Black founders and female founders?
So yes, there are actually. So I mean, it goes without saying, I think in the UK market at least, all VCs these days are very happy to work with people from different backgrounds. I think the days when people from different backgrounds wouldn't be able to raise, I think, are mostly long gone. But there are specific funds who work with people from different backgrounds. So if you're a female founder, there's a whole bunch of funds out there now. But the two that we seem to be most active in the female founder space are Angel Academy and Alma Angels. So they tend to be female founders. Black founders, so there's Black Seed VC, which is a relatively new VC aimed primarily at Black founders. Cornerstone also do a lot of work with Black and mixed race founders. And then sort of general diversity, there's I think it's called Diversity VC, has got a really good network if you come from if you sort of fall into one of the diversity categories. Also Community Growth Ventures, they do a lot of sort of diversity stuff. So have a Google, but there's a lot of early stage funds and later stage funds who specialize in specific specific sort of diversity groups.
Perfect. Thank you, Mike. We've got a question from Sanchez. Is there any complexity when raising both SES and TS at the same time?
Yes. It comes down to 2 points. The first is that gross assets points we talked about on SEIS. So you can't raise SEIS money if your assets are greater than 350k. So one of the problems is you're raising a 2 million quid round. If you let all of the investors for that round put the money in the company's bank account before you've issued the SEIS shares, that cash is part of the assets of the company. And so you breach that 350k threshold and therefore your SEIS is voided. So that's the first problem. And the second problem is one of the rules of the schemes is that you cannot issue you have to have issued the SEIS shares before you issue EIS shares. So you have to issue your SEIS on Thursday and then Friday or later you issue your EIS shares. If you get it wrong and you issue them both on the same day, you void the SEIS tax relief. So I think the simple version on this is if you're raising under both schemes, you need to get lawyers involved to make sure that it's done absolutely correctly, the funds are moved at the right time and all of that stuff.
Perfect. Thank you, Mike. And I'm going to take one final question, and that question is from Che. And Che is asking, should I raise investment before approaching supermarkets or afterwards?
I think it depends on your business, right? So simplistically, if you've got an LOI, a term sheet, even an actual agreement with a supermarket, your valuation is going to be significantly higher than if you don't, because investors can see a revenue stream. So in an ideal world, you want to raise investment after you've got some form of indication of interest from the supermarket. The problem, though, is for most businesses, when you sign with a supermarket, you then have to scale up your production probably quite significantly. And as we talked about, you're going to have timelines and obligations to deliver products to the supermarkets. So what you don't want to do is find it, you sign with the supermarket and you have to deliver products, say, in 3 months' time. And then you need to go out and raise the money to be able to produce that product. So that's sort of may push you to raise money earlier rather than later. Now, of course, sometimes what people do is they sign with the supermarket and then go and borrow money. And there's a bunch of lenders who will fund sort of stock purchase and stock costs where you have a signed contract. So they borrow the money, cover the scale up cost that way, and perhaps use investment money to repay that loan facility. So there are ways around it. And I think really it's just a question for you and your business, what is best and what works best and reduces your risk.
Perfect. Thank you so much, Mike. We are not going to take any more questions, but if you have any further questions, please feel free to email office@buckworths.com and you can continue the discussion with Michael there. Or if you would like to have the presentation slides, you can send an email again to office@buckworths.com. Make sure that you follow us on social media. We are very active on Instagram, LinkedIn, and Facebook, sharing lots of relevant content for startups. And also, if you scan the QR code, there is a direct link where you can book a consultation with Michael for free. There is also a link to sign up to our newsletter. It's a monthly newsletter where you receive lots of helpful tips relevant to the startup world, different articles, and our upcoming events. And early next year in January, on 9th of January, we are hosting a 3-hour masterclass on raising investment for startups. It's for a small group of 8 individuals where you can bring your cap tables, your business plans, your pitch decks, and really discuss them into a much greater detail with Michael, and he'll be helping you on how to structure your company to attract investors and what's the best way to get investment for you. So thank you very much for your time and enjoy the rest of your day. Bye bye.
Thanks everyone. Bye bye.